All right, I think we're ready to begin now. Hello and welcome to the CNBC Evolve Global Summit. We were in a breakout session looking at the economy and how we're going to be balancing growth and inflation in the coming months and as we move forward through this recovery. I am really excited to have this conversation today with two top economists who are going to help us separate some of the noise to find the correct signals. We have with us today Will Rodgers. He is a professor at Rutgers University and chief economist at the Heldrich Center for Workforce Development. We're also joined by Bill Lee, who is chief economist at the Milken Institution. Welcome to both of you guys. Thank you so much for joining us.
Thanks for having us.
Great. Well, Bill Rodgers, I want to start with you because you've done a lot of work looking at the labor force and at workers and how they've sort of weathered this pandemic. What we've seen from businesses is that restrictions are easing across the country. California just reopened yesterday. Maryland, in the Washington area where I am, is getting rid of its state of emergency as of July 1st. So businesses seem ready to sort of flip the switch and reopen, but workers still remain constrained in a lot of ways. Why is that, and what is this disconnect that we're seeing between workers and their employers?
Yeah, that's a great question, along with the the inflation question. We're waiting in bated breath for Chairman Powell's press conference this afternoon when he reports on the FOMC's deliberations. But what do we know now? I mean, that I think, like you said, I mean, myself included, wherever I go, I'm seeing signs or postings of help wanted, help wanted. There does seem to be evidence of a labor shortage that we've seen most recently. Wages start to rise, which is consistent with employers having to do those types of things to attract future employees or employees who are going to return. But there's a whole set of I would call structural types of issues that are creating this labor shortage that people are concerned about. One obvious one, and I think it's less of a reason now, but you have now up to 25 states have said, or they're going to be ending their unemployment insurance benefits, particularly the federal $300 a week amount. There's a new report that has suggested that there's a whole host of people who just retired. They're taking early retirement. One of the areas that I've been focused on has been on the role of child care and elder care, or the absence of it, and that it's been well documented that several million women have left the labor force during this pandemic. And even if we say schools are reopened, those schools are reopened in not necessarily piecemeal, but part-time, part-week types of structures. So that's created a barrier. But I want to pivot for 1 minute and then also interject and maybe throw out the idea. It was something that when I worked for the Labor Secretary in 2000 that we encountered, that we felt that there was actually also a skills shortage going on. And what I mean by that is that there are 9 million jobs postings, according to BLS data, but also if you look at those who are actively searching for a job, those who want a job, they've stopped searching, but they offer a job, they take it, and those who are working part-time but want to work full-time, that takes you up to about 16 to 17 million Americans. So there are people out there who want to work, but many of them have reported anxiety and depression in some of the work that I've done with some colleagues from the Century Foundation, and so they are going to need to be reboarded, onboarded or reboarded to help them get over the anxiety now of returning to work, whether it be concerned about workplace safety or just having to get back in that daily grind. So the reboarding piece is going to be very big, and there's also we have new jobs that have emerged out of this pandemic where there's going to need to be job skills imparted on people. So
just to go through some of the list of items you mentioned, childcare, skills, mental health, safety, unemployment benefits, federal action, all of that seems to add up to mean that those workers who are available to work are able to demand higher wages and better benefits. And Bill Lee, you've argued that worker wages could be the spark that lights the match of inflation in months and maybe even longer to come. Walk us through your argument for that.
The key to your question is higher wages could be the spark that sets off inflation, and that's a big could, because the offset to higher wages is that people deserve the higher wages because they become more productive. And people who grew up in the 80s or were born in the 80s and grew up in the 90s and 2000s, the inflation problem that has always faced them and the Federal Reserve during the time is that inflation hasn't been high enough. It has always come under the Fed target of 2%. And why is that? That's because productivity and the availability of lower cost goods and services from abroad has really contained the kind of price increases we witnessed back in the 70s and 60s. And the key to going forward is to have productivity be as high as possible, because productivity is what allows people to earn high wages, high real wages, that is after accounting for inflation. And the key to productivity is to have investment in technology. Now, Professor Rodgers is absolutely right to say there's a skill shortage out there, because the one thing about this U.S. economy is that the level of skills within the labor force has really dropped well behind where the path that it was on back in the 50s and 60s, and other countries have overtaken us. Our U.S. inflation story is going to depend critically on enabling people to be more productive in the workplace. And technology, aside from training, technology can have a place there too, because the software designers, if they can allow people with, say, a high school education to work the software and use the interface that these guys designed so that people with a high school education can be as productive as a college graduate. That's the challenge to technology designers going forward, and I think that's how we will meet the challenge of higher wages, higher real wages, by making people more productive through technology. And one other thing to get back to what Professor Rodgers mentioned about the Fed news conference this afternoon. The Fed story has always been the price increases we're seeing right now are caused by supply side bottlenecks. These, in the lingo of economists, are price level jumps, price pops. The sort of corrosive inflation that people worry about in the 70s and early 80s is where wages, input prices, material prices, and other costs well exceeded what the companies were able to push through in terms of price increases, and you had that squeeze in profit margins. You had workers falling behind because their wages were never catching up with the price increases. Expectations were always lagging what actual price increases turned out to be. That corrosive kind of inflation is nowhere near what we see today, and the Fed is well aware that they want to keep expectations of inflation to be anchored at that 2% level. They want you to be believing them when they say, we will let prices go up by no more than 2% on average over time. And we will do whatever it takes to do that. As long as people believe that, they will not demand 5, 6, 7% cost of living increases to catch up with and anticipate future price increases. So we have to distinguish between price pops and corrosive inflation.
So what I hear you saying is that you also believe that the spike in inflation that we've seen in recent months will be transitory, as the Fed does believe. We'll get a little more color on that this afternoon. But Bill Rodgers, what do you think? I mean, how long, we may see price pops, I like the way that Bill Lee put it, but how long might those price pops last?
Well, that's a great question. I think, but before I try to tackle it, I do want to offer an alternative, or not only an alternative, but another explanation for why wages have not increased during this sort of last few decades, or why we went into the Great Recession, the pandemic, where it was basically took us 7 years prior to the pandemic before wages really started to rise for workers. And that is, Larry Michel and his colleagues at the Economic Policy Institute have done some interesting work that show that not only is that also suggest that the reasons why we've seen wages been dampened is not necessarily due to market forces, but also due to employer approaches, such as non-competing clauses, which put a downward pressure or a lid on wage growth, or the other one at the public policy level, right? Many states have gone on their own to raise their minimum wages, and that's where we started to see the real wages of lower paid workers rise. So there's the market forces story, but there's also what Larry would call the institutional piece. Now, with regards to how long this is going to go on, that's really, I think, $1 million or whatever value you want to assign to a question. I think one aspect of it will depend upon, again, the speed at which we're really reopening. California reopens and other places reopen. The other thing I guess would relate to it would be if we get additional the infrastructure package, if that comes sooner than later, right? That could then also to spur increased demand, and that part of the explanation, right, is that people are saying that firms have not been able to meet the increased demand, and so that would just even shift the demand curve out even more and more, which would then put upward pressure. But as Bill said, though, the real key for me in going forward is the Fed managing people's expectations. Because if I start to think that you're going to be raising prices in the future, right, then that's going to trigger me to ask for higher wages, or it's going to trigger other companies, organizations to raise their prices. And that's the big challenge, is managing expectations.
So we've been talking about some of the sort of macro forces swirling around in the economy, swirling around a lot of businesses right now. Let's take it down to the micro level if we can, and talk about, individual companies, individual businesses. What do they need to be doing to steal the name of the session, balance these two risks? On the one hand, they need to encourage their workers to come back so they can meet the, unexpected amount of demand that we've been seeing. But on the other hand, they got to focus on the bottom line, and there's a lot of concern about where prices are heading. So do you guys have advice for businesses on ways that they can address their workforce while also keeping an eye on the bottom line? Either one of you can feel free to
jump in. Can I start with that? Because I want to get back to your question of how long is transitory. That's the reporter's favorite questions these days. And I think the Fed's response best from Vice Chair Clarida when he said, it's not so much how long will it take, it's situational. When will the supply be there to meet the demand? When can we get the chips to produce the cars so that we have more cars in the market, so the price of used cars will come back down again? When is the lumber going to come from Canada once the truck drivers are able to get back to work again? So it's very situational. And from the micro perspective, what does a businessman do when he says, I've got this job opening here, I'm trying to open up my business, I've got lines out the door wanting to come into my restaurant, how do I get people to come here? And right now people are saying, oh, they're just increasing wages. And I think that's too gross an answer. Instead, what you should say is, a lot of companies are offering sign-on bonuses, one-time price increases, one-time wage increases to attract people in. Once business starts to pick up again, that tip income is going to start generating. The restaurant will be much more successful once you start people coming in. But you can't get people to come in unless you have the worker to start giving the services. So the key to allowing workers and to be satisfied right now to come back into work, and for bosses to open up businesses and start having some profits, is more of these one-time wage increases. The key to one-time wage increases is that they're not inflationary. They don't carry on and become embedded in this wage price spiral. So I think the secret to a safe opening, which I think the Fed is trying to promote, is one-time price increases, one-time wage increases, and let's hold it right there.
Yeah.
Bill Rodgers, do you agree?
Sure. I would agree with the wage increase, but I'd also agree with it. I would also expand it to compensation, right? That our listeners who are here in this session, right? I mean, they also hold the purse strings on other things beyond just wages. And I was just talking with people and cultures individual, and they're thinking about it's nothing firm, but they're thinking about how to potentially help younger people, millennials, who have student loan debts, is to help address them as a way to draw them in. I think the other area, and I mentioned it as a part of your skills or your labor shortage question, I think when you have about 25% to 28% of your population is self-reporting that they are severely anxious or have some sort of depression, that I think what that is going to mean is that as people in culture, representatives or human resource or whatever your titles are, you're going to have to also be show a level of compassion to many of your employees, whether that looks like having to really help out with the new skills or re-upping the skills, or even just helping more around emotional issues and mental health issues, whether that looks like allowing individuals to sit and talk about what the isolation that they felt over the last year, and to having opportunities where people can get professional help. That those reboarding types of activities are going to be very, very important.
Non-monetary benefits and compensation, if you will. I want to just welcome anyone who might have joined in late. You are listening to and watching CNBC's Evolve Global Summit breakout session on balancing growth and inflation. We are taking questions from the audience. If you have something, you can go ahead and put it in the chat. And one thing that's popping up here is that, the reason why the Fed and a lot of economists like yourself seem to believe that some of the price increases we've seen are temporary, transitory, is because they're sort of happening sort of sector specific. But one place where we've seen continued price increases, continued strength is the housing market. Wondering how you guys are viewing housing prices and if that is feeding in, or that could feed in more long term into an inflationary story. Billy?
That's a great question, because housing is a very special kind of a product. It's something that we use because we need to live there in a place. So it's housing as a place where we live. But there are also people who buy houses because it's an asset. And an asset means that it will deliver services well into the future and give us income well into the future, just like a bond or a dividend. There are rentals associated with owning a house, whether you pay yourself the rent or you actually charge rent to somebody else. So that asset quality of housing is something that has really shot up. Just like you see stock market has shot up, a lot of assets have gone up because we live in a world where the Fed has pumped a lot of liquidity into the markets. People have a lot of money to spend, and they realize that we don't just have to buy vacations and services that are immediate consumption, but it'd be pretty slick and smart to put some money away into an asset. And so that's why you see the value of housing jump up like crazy, because the asset value has gone up, but also our lifestyles have changed in the post-COVID world. A lot of people are saying, I don't need to live in this crap little apartment here in San Francisco, New York, name the city. I can go to a suburban area where I have more room, I can have a home office, I can telecommute, and I will have a much better lifestyle. So that shift in demand, especially among millennials, was discover, once I have the second baby, there's no way we're staying in this apartment. And the second babies are starting to come out now, and more. Millennial demand is really popping up.
People were busy during the pandemic, Billy. but Bill,
it was either getting married, getting divorced, or having children,
or getting a dog,
That's right, the pet.
Bill Rodgers, I want to ask you this because he points to a really good dynamic here, and a really important dynamic, which is that people have dispersed during this pandemic, and I want to end with asking you about how that might impact the types of jobs people take in the future. They may not be able to return to their old job because they're not even in the same place anymore.
Yeah. So when I was at the Department of Labor in 2000, we created this volume called Future Work: Trends and Challenges for the 21st Century, and I think it's still very relevant. And at that time, we identified basically three major structural changes in the economy that we're changing how we work, where we work, when we work, and with whom we work. And at that time, it was technology, globalization, and then changing population demographics. And now the pandemic has created a new structural change. Because if you listen to the Dr. Fauci's of the world, we have been in a pandemic world already, and so we really have to. And that has, again, changed how we work, where we work, when we work, and with whom we work, and particularly where we live. So your context is your housing question. And so one of the things that I've been sort of beginning to advocate for, particularly not just workers, but just helping everybody be on the same level, is we probably need something similar to the American Disabilities Act, but in the context of workplace safety around COVID. And not just COVID, but these viruses. That how do we get people into buildings safely and to where they minimize potential transmission of not just COVID but other types of viruses. And so that's this new place we're at. And the public sector, the government really does need to lead that conversation as they have been thus far, but they really need to continue.
I think I can sneak in one more quick question here, guys. Do you think that as we exit the pandemic, that the economy will be even stronger than it was pre-pandemic? Do you think that's a possibility?
Oh, absolutely. I think the productivity increases that companies have put in when they realize that when I come back online again, I've got to be leaner and meaner and be able to do with less and fewer people. That productivity jump we're witnessing right now is going to be key to higher real wages and better cost of living for everyone, all the workers out there, but also be key to resolving any fears of inflation, because we're going to go back to the world of disinflation, where inflation will actually start to come in below the Fed's target.
Yeah.
Rodgers?
Sure, thanks. Yeah, I'm concerned that we used the 3 R's during the Depression. We're not in the Depression at all, but relief, recovery, and reimagination. And to the degree that we are able to reimagine the economy, reimagine workplace safety, reimagine how people are compensated to address the economic security challenges people were facing prior to the pandemic, will be stronger. For example, the Federal Reserve has this wonderful survey that found that roughly about a third of the population prior to the pandemic couldn't pay an unexpected bill of $400. And that was in a time of prosperity. Other examples or concerns about that time, the participation rates had not recovered for many groups to what they were prior to the Great Recession. So it's really going to be, the answer to your question really depends upon how much we are willing to reimagine how relationships are done in the economy, such that those productivity gains that Bill is talking about get dispersed throughout the economy and create economic security for all Americans.
Well, here's hoping there is a light at the end of this very long tunnel. Bill Rodgers, Bill Lee, thank you guys both so much for joining us today. Really appreciate your time and your insights. I want to let our audience know that the main stage programming is resuming now. There is a link in the chat, so please continue with watching the amazing programming that we have today for you at CNBC's Evolve Global Summit. Thank you so much.